Ladies and gentlemen, boys and girls, listeners of all ages, welcome back to another exciting episode of All Things Litigation Funding. I'm Ted Farrell from Litigation Funding Advisors. We have David and Evan here from that scrappy upstart in the business, Burford Capital. Guys, thank you for coming on. Can you guys each just give a little quick just intro on you, a little bit on your background, then we'll talk about Burford, and then we'll get into some more stuff. And I guess we'll go left to right, but don't worry, Evan, because in the second round, like fantasy football, we're going to come back around. So you're going to have plenty of time. So David, why don't you give just a little brief intro?
Sure. And Ted, thanks for having Evan and me on. We're delighted to be here.
Yeah, of course.
I am the vice chair of Burford Capital, been with the company 7.5 years, had a long career, originally as a lawyer, law firm, in-house, then was an entrepreneur, built a business, sold that to Thomson Reuters, did a stint at Bloomberg Law for 2.5 years and came to Burford and have really done everything at the business except for what Evan does, which is actually make our investments, underwrite them, and close them.
So you mean the hard work?
Basically, that's correct. Leave that.
Well done. Well done, my friend. Actually, maybe we should toss Evan and talk about how you get to do it. Anyway, Evan, how about a little brief intro too?
Yeah, thanks, Ted. I'm Evan Meyerson. I head up our U.S. commercial investment team, which in Burford speak means everything that we do in the Western Hemisphere that does not involve patents. That's the team that I oversee based out in New York. I joined Burford in 2019, so about 6.5 years ago. And I joined from Paul Weiss, where I was doing general litigation. Before that, I clerked on the U.S. District Court in D.C., and before that, I spent some time at Sullivan and Cromwell.
Got it. Okay. So I'm going to, and I'll let you guys go whatever order you want, but I do ask this of everyone because I think that people are sort of interested. What was the first time you either were involved in a funding deal? Like, how did you learn about this business at all, given that it's still like relatively new?
Yeah, we're starting with me this time.
I told you it's reverse snake order draft, of course.
Yeah,
exactly.
Sorry, we'll be in more.
But it's also like, what's that game show? Yeah. What's that game show where you can pass? Like, press your luck. So if you don't like it, you also get to pass when it's your turn. So.
Yeah, that's good to know. So my origin story is perhaps less inspiring, and it involved a recruiter approaching me while I was at Paul Weiss at a time when I was looking to leave, with the question, have you considered litigation finance? And my answer was no. What is that? And I was set up to speak with, we won't name names, a fund that is no longer with us, but out at its founding. And while perhaps there was a quick mutual decision that my employment there wouldn't necessarily be a good fit, the idea I thought was fascinating. And so I took it upon myself to quite literally cold email, or as warm email as I could, other players in the space that I had Googled in my intensive research process. And one of those was Burford. As I joke sometimes with John Mallow, I think I sent him an email that started, "Dear Jonathan," and noted that, like him, I also attended Harvard Law School, and that was about the basis on which I hoped he would give me a job.
That small little law school outside Boston, right? Yeah.
Yeah,
very tight knit.
I try to leverage it for all it's worth, and he very promptly forwarded me to Aviva, who thankfully did hire me. And that really is my Burford origin story.
Oh, how about you, David?
Yeah, so all roads, I think, run through Aviva at Burford Capital. I was actually a corporate lawyer and then an entrepreneur. I had just sold my business in late 2010, and a mutual friend of Aviva and mine sent an email to me and Aviva saying, "You're both doing innovative things in law. Aviva only recently joined this company, Burford Capital. Perla just sold his business. You two should meet." There was a conference. I want to say it was a litigation finance conference. And I went by basically to meet her, and there were some outsourcing people there. That's what I was doing. And we met and stayed in touch. And I kind of put her on some panels in some businesses I was involved in, and had always thought the world of the company. Chris was sort of a known guy in the 90s, Chris Bogart. When he left to become general counsel of Time Warner, that was big news in New York City circles. And so I'd known the company and didn't really have a sense of where could someone with my skill set fit in. And then years later, when I got a call from a recruiter about this kind of unique role, I actually called Aviva before I called the recruiter back. And then it all sort of moved from there. And that was, now you're looking almost 8 years ago.
Interesting. Okay. So for those who don't know, and look, we have a couple of different kinds of listeners. Obviously, everyone in the business will know about Burford, but there's people who listen to this podcast who are looking to get in, sort of like, at least where Evan was, or B, there's people looking to make investments in the space. So I'm interested if you all could just give a little bit of a background on, literally what Burford Capital is. What do you guys do over there?
Sure, I'll start on this one. Burford is what I would describe as the largest provider of capital toward legal assets globally as a pure play matter. It is what we do day in and day out. There are large asset managers out there that dabble in our space and have arms that touch litigation finance, but in terms of a business that does this every day, Burford is the largest globally. We're a public company. We're listed in New York, cross-listed in London. And while our origin story starts with funding the fees and expenses for clients with meritorious legal claims, looking for ways to offset some of the cost of those claims, or funding fees and expenses for law firms who are taking matters on contingency and looking to offset some of the risk of their contingency, that business has grown substantially over the last half decade, I would say, to really become what I like to describe as a corporate finance solution for law, for legal claims. And what that really means is, we are in many ways the familiar corporate finance solution that companies and large institutions rely on in their daily lives, but instead of financing against cash flows or real estate, we finance against future proceeds from litigation. And so it's with that concept in mind that I think our business has largely shifted from what was initially conceived of, I think externally more than internally, frankly, as a David versus Goliath business model, to something where we are a corporate finance provider, not only in times of need, but when it just makes sense financially to think about offsetting risk and costs.
Right, because nobody has the P&L for complex affirmative plaintiff side litigation that only happens once every 5 or 10 years. I guess, David, it looked like you were going to get in there. Sorry.
Yeah, I think that's right. I think if you look at who we are as a corporate team, Ted, what Evan said is right. We don't think of ourselves as David versus Goliath. You might even hear people say access to justice. Well, all of those are laudable, and we certainly help. If you look at our backgrounds, we all come out of large law. We come out of in-house departments. Evan worked at Bain Capital. I sold a business that represented the largest companies around the world. My company was built on working with corporate legal departments and with the large law firms that serve them. Chris, John, Aviva, our finance people, our chief strategy officer, our CFO, all come out of sort of large corporations. So our DNA is actually helping large corporations and helping the law firms that serve them. So we like to think we're in the business of helping organizations look at their legal assets, value them, and monetize them, or at least offset the risk of those assets.
Right. And so, what I see externally, and especially a lot of talk about this business, like you would almost have it perceived as the litigation finance industry forces people to take this money and then all these horrible things happen. But in fact, I know people are calling you with business challenges. What's sort of a typical thing that might get teed up for you guys, and how can you solve that in a way that recourse bank money with current pay and all that stuff, other traditional forms of finance, what do you got? What's the solve that you all are offering?
Yeah. So should I take that one?
Yeah, sure.
I think it's different sides of the same coin when talking about corporate counterparty to our deals or a law firm counterparty.
Let's do the corporates first, and then we'll do the
for a corporation, there are different flavors of it, but the flavor we've seen most prominently over the last half decade is a version of what you described, where it's not a question of can this company afford this discrete piece of litigation, but what is the opportunity cost to doing so? And how does our solution differ from those that corporation might have access to otherwise? As a starting point, what we are offering is a non-recourse solution. So from the jump, we're not taking a first priority lien on all cash flows imaginable from that company. We're
and let's even and so right. And sorry to interrupt, but this is important. When you mean non-recourse, just so we can spell it out for me, that means, I think, and let me just I better understand this at this point, but that basically means you're gonna offer X dollars against some certain litigation outcome. But if that outcome is unsuccessful, unlike a general obligation, right? If the proceeds either are zero or fall up short, that's your total return. Just so everybody understands when we use non-recourse.
That's right. If your litigation outcome is a success, we share in the proceeds of that success. If your litigation outcome is a failure, you keep our money. And that proposition, certainly informs how we price to the risk, but it also means that it's a pretty attractive solution if you're a company not looking to either further dilute equity holders or take on more debt, and you have this meritorious legal claim that should be viewed as an asset, but surely Citibank is not going to view it as an asset, and Wells Fargo, whoever you're typically borrowing from, and instead Burford's bringing its expertise to bear to value that, to provide, if it's a more progressed, advanced litigation, potentially meaningful cash up front, or at least fund a portion of the cost to pursue that litigation so that you're not leaving money on the table while similarly not diluting, again, your equity holders or having to take on more debt. That's sort of the core solution for corporates. And whether that takes the form of a large portfolio deal where we're monetizing against a bunch of different assets and literally cutting a check up front as an advance on damages, or a single case where we're helping offset the cost of pursuing that litigation, the fees you might pay and the expenses you'd have. It's the same concept. I don't know if you wanted to get into law firms.
I think just to layer on that, Evan, if I may, one of the things people are always trying to figure out, do people need our money? Do they want our money? I think the easiest way to understand what Burford and what people in the industry do is, for almost no corporation is litigation their primary business. And if it's not your primary business, to take on that kind of expense, we all acknowledge litigation is extremely expensive. It's also a pretty good way of resolving disputes in rule of law countries. It tends to work. It's just very time consuming.
Yeah, that's sort of forgotten too. That's the whole reason it's exist, right? I mean, well, what's the other? What's the alternative, right?
What's the alternative? I mean,
drive by my house. Yeah,
look at non-rule of law countries, and you'll see the alternative, right? Or look, I used to spend a lot of time in India, and there are a lot of ways to get hurt. And I used to say the reason you'd see all these dangerous situations there was there's no tort law. It was just an example of law tends to actually bring salutary benefits. And I think we forget that, but it's very expensive and it's very time consuming. And for most people, it's not their core business. So all we've done is what great businesses have done historically, which is, we've made our business someone else's expense, someone else's headache is our business. And there's a cost to that. It's not if you're in the litigation business, we can pull the risk. If you're not, it's very hard to pull that risk in addition to take on the expenses and the risk to begin with. So that's kind of what we've done.
Right. So you teed that up perfectly, because now we're going to talk about risk, and I think this goes to the law firm deals. So what I see all the time, you all see all the time, is law firms are just typically not built to take multi-year risk. And so I want to talk about how you work with law firms to kind of, lay off at least some of the risk on what can be, some promising cases, but it might take 3, 4, 5 years to money and all that stuff. So, when a law firm comes to you, how are they looking at it, and sort of what's the solve that you all can give them?
Yeah. And look, there are firms out there that build their businesses around contingency litigation. Some of those don't use litigation finance, and they're willing to bankroll that risk themselves. For the most part, however, I would say the types of opportunities that we're exploring with law firms and the growth driver for our law firm business is, I think, what you'd call pie expansion. So we're working with the largest law firms in the United States who, by most accounts, have traditionally been defense-focused, billable hour-driven business models, who have seen two things happening, both of which kind of go hand in hand. One is that rise in I would say, like the corporate learning curve over, again, the last half decade, where you have corporations that were, typically only reacting to being sued and not pursuing affirmative litigation. A lot of those companies are institutional clients of very large law firms. And as they've seen the light on pursuing affirmative and valuable claims, the law firms that have catered to them on the defense side don't want to lose that institutional business. But as you said, Ted, those firms are not necessarily set up on day one to take on all of the risk in a competitive marketplace where there are other firms offering their institutional clients contingency fees. So a lot of those firms will turn around and say, how can we compete in that marketplace and expand the pie for revenue streams on our, in our litigation department, and put together attractive contingency packages, right? Like AmLaw 20 firm X will bring the global resources of its firm to bear for you, client Y, for free. That's a pretty powerful pitch. But AmLaw 20 firm X doesn't want to front the expenses of that litigation, and their partners need to see some cash flow, which, along what could be 3-4 year duration litigations. And so they turn to us.
And I think that, and I think that they want a lot of them, there's been a couple of, large antitrust cases that have just been sector specific. And you've seen, we have an institutional in this sector. We want to talk to the head of the antitrust group about bringing this claim. They want to serve their client, right? The client counts on them for everything else. They count on them for M&A. They count on them for counseling, this, that, but they don't have, the ability to put out $4 million in expenses and have 12 associates and 3 partners huffing it for 3 or 4 years. So it's kind of like, it's almost like a gap filler, sort of how I look at it.
That's true. And look, what I like to say is the most eye roll worthy of my pitch always is the idea that Burford is smart money, right? Everyone's always like, yeah, everyone says they're smart money, whatever. But the truth is, especially for large firms where we're putting together pretty massive deals to help them take on either one flavor of antitrust litigation or a pool of cases across various practice groups. One theme is, like, these firms are also not adept, because they just haven't spent time doing it, in crafting contingency fees and thinking through the portfolio economics of taking on risk. And alongside our capital, we become hand in hand, a trusted advisor to help them think through how to structure those business relationships. So, I think one differentiator for us has been our ability to be a helpful partner in what are otherwise pretty passive investments. And that's helped us grow, and it's helped us partner with firms that are growing.
Yeah, and I think they look at it differently too. So you have to be, some firms need it this way, some need it that way, and that's really important. Go ahead, David.
Well, yeah, that's exactly right, Ted. I mean, Evan, I'm thinking of the 2 recent ones. Where one was a very large.
Hang on. Did you have cool project code names for these? Can you even share those? Was it like Project Griffin or something like that, or Project something exciting?
We share them, Ted, but we'd have to kill you afterwards.
So. That's fine. That's fine.
Sorry,
get in line. That's right. Yes. Get in line.
Yeah,
that's fine.
So one is a type of firm where it's really a classic kind of like AmLaw, it's probably a 20 giant, historically defense oriented. There's not consensus around what they should be doing with alternative based fees. And then you have firms that are really invested in the, we've got clients that are really invested in the upside that want us to either help grow because they don't want to take more, a higher percentage of work in progress than they already have, or sometimes they don't want to put more money out of pocket on expenses, but they're comfortable with the billable hour risk, as it were. Right. So they're really focused on, how do we do more of this? They're not as worried about, well, I have to recapture my billable hour. So no firm is really like any other firm.
Right. Well, I think what they all want is, well, if you just give them 100% of their fees, pay all the expenses, and like 99% of the ups, they're your guy. You got them. Like, you can just sign them up. It's just sign them up. It'd be great. It'd be good.
I think joking aside, what they really want is not to be left behind.
Yes,
and I think
yes,
as firms are seeing the same thing I saw, having come from a place, I dare say, like Paul Weiss, which is exactly the defense-oriented, billable hour-driven firm that we were talking about, and didn't do a lot of plaintiff side work, and certainly didn't do it on risk for most of its history. There is still a running assumption that no one else is doing it, and that's wrong. And so I think it is
totally wrong.
eye-opening
Totally wrong.
for firms that see some of their corporate institutional clients going elsewhere, not just to the firms that you've seen taking on contingency work very publicly, but instead to what they would consider a competitor. And that is an eye-opening story for them to pay attention to. I think it's important to note that doing corporate business is still an enormous part of Burford's growth story. That has been a big focus for us, and it has been a huge part of our growth curve. But funding large law firms, providing a financing solution to large law firms, is in many years just as big a part of that growth story, and it's there to stay for us, right? Like, that remains a huge focus for us, being a partner to law firms, because there are continuously opportunities to work hand in hand with those law firms to build books of business, to take on meritorious litigation.
Interesting. Okay. Well, I want to shift a little bit, and I want to talk. You guys might have heard there's been some current events in the business relatively recently, including perhaps some regulatory stuff going on. I'm just sort of interested in what you all are, as you're looking around at the business. What's interesting, that you guys are seeing that's going on now, if anything, or maybe there's nothing interesting, save for the three of us chatting.
Yeah, I think in terms of the industry, there's the business side, and then there's the regulatory side, Ted. And I can certainly cover the regulatory in a second. Evan and I probably have a lot to talk about and think about on the business side. I think one area we're seeing, everyone is talking about monetizations. Right? Everyone is talking about the recognition that not merely judgments, but claims that are well understood and are in some level of progression have real value today. And corporations are recognizing, to use Evan's line, that this is nothing but corporate finance for law. It's actually simple to understand it if you're a CFO. So the idea that whether or not we've paid for the fees and expenses of litigation, the client has paid, or in many cases, a firm has taken the litigation on risk. So it could be any one of those three. The claim and or the judgment has value. And, we're on record as having done a deal with a very large Fortune 100 company a couple of years ago, where we did a facility north of $200 million that looked like a corporate finance facility. It looked like a classic capital facility, using their litigation as the backbone of that facility to put a few $100 million of cash into the treasury. I think that's a really prominent trend we're seeing now. It's also driving corporations to think differently about when to come to us. I think, Evan, if you think about like when the phone rings, they often want to talk about kind of programmatic approaches and how they might access our capital, and then talk about the claims. So they're starting to think about it as a program and as kind of classic finance. I think, 5, 6, 7 years ago, every conversation started with a particular case. I think that's really changed.
Yeah, no, I think that's right. And what I see, which I think is encouraging, is even the law firms handling these cases are saying to the business people, you may have a chance to pull forward revenue. We may or may not want to be involved in that process for you, but you should know that in this case that we're going to opt out of, or whatever it may be, or a long run MDL, that there is the ability to pull forward revenue. And I think, businesses are always looking at the best way to capitalize. When people ask me about litigation funding, I say, it has to work for the counterparty too, right? There's no litigation funding business if there's not a capital amount and structure that the counterparty wants to take. So whether you're talking about, the ABS law firm, the MSO model, the corporate monetization, the contingent fee, like it's all academic unless that meets the counterparty where they are, which is this is better than our option. Instead of going to a bank and paying current interest for this, we're going to do it that way. So I agree with you all that the monetizations have been super hot. All right. So now I want to move on from that because I think we kind of covered that. But I'm going to ask you, and you can each go or we can just have one, but what do you all think is a misconception about how this business works?
Evan, you want to take it?
Sure. Well, I think Ted, you touched on a couple of these earlier, right? Like need versus opportunity cost and want, who the participants are, what the diligence process is like. I think as you've said previously, Ted, the lowest hanging fruit in this conversation is this very self-serving concept of frivolous litigation, as if Burford, a public company with a balance sheet, is going to casually put its cash at risk to back dumb claims. I think for me, the
in fairness, when you're the defendant, every claim is dumb. Don't forget.
That's true. That's
depends
true.
who you ask. That's right.
I think if you're a lawyer, every claim that isn't yours is dumb.
That's true. That's true.
I think the more ground level market based misconception that I fight through every day is the one that I flagged a few minutes ago, which is some version of surprise. Everyone else is doing this,
right? And
somehow that doesn't make its way around the market, right? Like this idea that litigation finance is still confined to a tiny quarter, tiny little corner of the legal market is not true. Burford works or has worked with the vast majority of the AmLaw 100, either doing deals directly with those firms or with their clients pursuing litigation with those firms.
And with full knowledge of the firm. I mean, so the client says, we're going to borrow money from Burford and you're going to send your invoice and it's going to pass through. So it's not like they don't know exactly what's going on. Right?
And if you look at, I have not memorized the membership of the Chamber of Commerce.
I have.
Yes, I know you have. If you think about how many of those members are also active users of litigation finance, I've always found that nothing undercuts an argument against its use case than participation by your own membership. And so this really is, I think, we will always continue to fight against bad faith arguments that are out there to protect a resource advantage.
Right.
But litigation finance is something that, the largest corporations in America and the largest law firms in America and across the globe are using frequently. And that to me continues to be part of the education curve for us.
I think Ted is, this, right? But for the average listener, every defendant hates litigation, but by definition, that's not wrong. That's just, we're capitalists, right? So whenever you're on the receiving end, you hate the litigation, whether you've caused the harm or not caused the harm. But to Evan's point, the corporations, when they find themselves harmed, whether it's antitrust or it's patent infringement, or it's a business tort, they are coming to us. They are coming to our peers, and they are seeking our capital for all the reasons we talked about.
Well, and also, they have a fiduciary duty, right, to their shareholders that when they are wronged in a business tort, right, where they just let it go, right, just let it slide. Yeah, there's $100 million in price fixing. Let's just let it roll because we don't like litigation. I mean, that's just not how the world works.
Right. And there are a not insubstantial number of companies where we know they're opposite on matters where we're funding a counterparty that are coming to us on something else.
Yeah.
So we know they don't like the idea of finance because they're trying to use their own capital as an advantage when they're a defendant. But when their capital is at risk, when they're plaintiff, they really deeply want our capital. And by the way, we don't begrudge them that. Everyone's playing their role as a capital.
It's what it is. Exactly.
Yeah,
everyone has to be grown-ups about it.
Yeah.
Yeah.
I think one of the most telling aspects of this is if you think about the percentage of repeat business that Burford does, you see this thing where once you've, cracked that nut the first time with a counterparty that may have been unsure of pursuing something involving legal finance, once they've used it and once they've worked with Burford, the number of times we do a repeat deal is astronomically high, because it is sort of again, it's the learning curve. You have to get through it once, but once you do, people understand what the value proposition here is and want to use it again and again.
And the business folks, when the call finally goes with the CFO, they say, so this is off balance sheet and number. They get it before the lawyers, I think, understand it, because it just is economically rational, especially when you have a complex claim where the experts are going to be $3 and $4 million. It's not just made for any small law firm to handle, when it's difficult. I just really worry when those Chamber of Commerce members, if they win over $10 million, do they just cry because they caused another nuclear verdict? I don't know if that's like something they really worry about, but anyway, okay. So I'm going to ask you guys this either on a no names basis or in violation of all NDAs. I leave it up to you. What is a case that you all feel, while you're not in the David versus Goliath business, what is a case where you feel somebody was really wrong? You can even talk about the one that was on 60 Minutes. Someone utilized their capital to really right something that was wrong. And again, this can be sort of broad and general, because look, I think one of the reasons our business is such a great punching bag is, we sign an NDA at the outset of the litigation. It's often not public if funding's involved. And I don't think people hear sort of the positive stories of levering this money. So is there one? And again, you can do it at a very high degree of, no names. And then, of course, I will try to sleuth out who it was. But, anyone you all can think of?
Yeah. Why don't I make it easy? I mean, the one in 60 Minutes, I'll cover it briefly, but there's a different one I want to sort of explain. 60 Minutes was easy. Was a family-owned business that was the provider of peppers to the largest sriracha manufacturer. And in breach of the contract that had been agreed, was boxed out of that contract, won a judgment, and then was out of money and couldn't collect on that judgment and came to us. That's a well-known case. It's been well publicized. There's an earlier case we did with a company that it's a little bit of a Dave and Goliath. It's called Shave Logic. It was sued by Gillette. And interestingly, it was a defendant. We don't normally talk about defendants in this case. It found itself as a defendant. And Gillette was using litigation to try to put this company out of business.
Oh, I'm shocked. Oh my gosh. I'm so glad I was seated. Yeah. Oh man. Boy, you've shaken me to the core. Boy.
We actually looked at that case and we thought not only was the case on merit, we thought they had a terrific counterclaim. Mm-hmm. And we funded their defense and counterclaim and won that and kept them in business.
Do you have like a monopolization counterclaim or something like that? Okay. Anyhow.
Yeah,
okay.
You can look it up.
Okay. But I'm not going to look it up.
That's a really good example because they actually had a new lease on life as a result of the litigation. And when we were facing a state bill that we viewed as harmful to legal finance, it was dressed up as a disclosure bill. It wasn't. It was really designed to hurt the litigation finance business. And the Speaker of the House and the legislature asked us, "Is there any companies you've helped here?" This was the case we brought, and we showed it to the Speaker, and he had no idea that this local business down in Texas had been helped, kind of being threatened by a large out-of-state corporation. That was very meaningful. It's this very real-world example of, litigation has an appropriate role, but you have to be well-funded, whether you're the plaintiff or the defendant, or in this case, both. So I think that example, it doesn't have the spice, as it were, of the sriracha case, but I think it's a really good one.
Well, no, and I think it's that having that wherewithal. I had I was doing a funded case once, and they were clearly trying to bleed us, and in fact did not know that we were funded. And then we accidentally produced the funding agreement in discovery. And of course, I got yelled at. But interestingly, all the stupid stuff kind of stopped because they realized every time they wrote a dumb letter that we had to spend 20 hours responding to, we were getting paid for it. And that case ended up resolving for just about what we claimed it for, because they're like, well, it's not going to be asymmetrical. So like, we may as well get down to it and settle this case. All right. So
Ted, there's some recent academic writing on this topic saying, in spite of what opponents of the industry say, that the presence of finance drives up settlement costs, that actually drives it down. Yeah,
because you're not going to bleed them, so you don't need to write, the motion to reconsider, right. The motion to reconsideration. Yeah, right.
And if the defendants know about it, they realize that everyone should just sit down and talk about what an appropriate settlement number is, rather than trying to force a plaintiff to capitulate.
Right. That's interesting. So I'm interested a little bit on what you think is going on with regulatory business. What is besides cutting a check to ILF or whatever organization, which is important, by the way, right? It is important that we not have free riders. I can accountability, but what can, normal sort of like everyday people working in the business, like what's something you think you can do? Because I know you guys are connected with everything that's going on, and I'm just sort of interested what you think.
Yeah. I think, first of all, you mentioned ILFA, which is the International Legal Finance Association. That's the main trade association. I do think people should join it. So it's not merely cutting a check. I think law firms that benefit from legal finance should join it. Law firms that represent finance companies and funders should join it as a first step, right? For me, that's table stakes to really be in the industry. So I don't want to minimize that. That said, I do think what people should do is not simply think, well, I'll call my senator, I'll call my member of Congress, or I'll lobby based on the arguments that I think are the ones. And here's why. What our opponents do is very clever. They find angles to come in that work for the individual members of the Senate or the House, or frankly, they'll find jurists that are sympathetic to a point of view. And so there's a lot of advocacy that can be done, a lot of lobbying that can be done individually. But I would ask that people talk to ILFA or talk to some of the leadership on the lay side of ILFA, the members, the funders who are on the executive committee and on the board of ILFA, and ask who is influential. What are the arguments I should be making? And it's not straightforward. It took me a long time to understand.
It's different for different people. 100%.
It's different for different people. And if you go in and you just say, well, it's access to justice or it's rule of law, that may not resonate. And you have to know what senator you're talking to, what moves her or what moves him. And if you're educating a jurist, if you happen to talk to a jurist, what are the things they think about? What are their views on the industry? So I would encourage them to ask, actually, and not be reflexive about, well, I'm going to make arguments that this persuaded me, so I believe that's the argument. And to just find out. It's an easy phone call. You can call the head of ILFA, or you can call anyone involved in ILFA from a funder, and they'll be able to get you the answer depending on who you're going to talk to.
Got it. Evan, what do you think? You're dying to chime in here. You're going to tell me to freelance and make my own arguments? Is that what you're going to tell me, to ignore that advice?
I would never say to ignore David Perla's advice.
But we'll talk. You can text me to ignore him. That's totally fine. Okay. So I want to ask you guys one last thing, because I do think it's important. I mean, look, I'll get called. A company or a law firm who hasn't done this before will call me. And frankly, we live in a business of some of the greatest websites you've ever seen. Each funder, each person, some of them, Evan, believe it or not, even are as impressive on paper as you guys are, right? It's incredible, but it's true. What is the difference, right? So in other words, what I tell people all the time, and I often say this when we're looking at 3 term sheets, and for example, I'll tell someone to sign the one that's most expensive, and they'll be shocked, and I'll say, well, that's like 95% to close, and they're not going to drive you nuts, right? So unlike getting your mortgage where you apply, and it doesn't matter who's going to sweep your account, every month for the next 30 years. What do you guys think are, when people are thinking about who they want to do these deals with, what do you guys think are some of the subjective things that really sort of, you guys think stand apart? Because, and look, you guys know as well as I do, there is a huge subjective element to this business because it is a long-term relationship, after the closing email comes in on Friday and whatever. So what do you guys, when people are thinking about who they want to do business with, what should they be thinking out with how you all operate?
Yeah, I think of it in terms of what happens when the going gets tough, right? So despite all of our best efforts to predict how a litigation will play out, both in terms of the various ways you can win and lose, the various ways it might settle, how long it will take, what happens when some of those predictions go wrong? And
Well, I know what happens. If you complain, I'll say you told me you were the smart money. Sorry, dude. You guys did all this work on this.
Well, I think what we've seen time and again is a version of the same outcome where if someone prioritized, cost of capital to the penny and didn't really think through what is the capital source behind this capital provider? Are they a 2-in-20 fund? Do they have a single LP? Or are they like Burford, a balance sheet driven business, a public company that I can watch how their finances work over the course of our relationship? What happens when that budget gets blown? What happens when the case takes 3 or 4 or 5 years instead of 1 or 2? Is that funding source literally still around, right? Like we have an attrition problem in our industry. Funds that existed in 2019 when I started are very different today.
Wait, Bannon Capital's gone?
Right.
Oh,
So
man,
we have Ted Farrell doing podcasts.
I know, it's terrible. I know. And I work for Perla's predecessor, Bloomberg Law.
Yeah. Hey, I interviewed with Van.
I thought we were going to do so great. We were gone before I started, pretty much.
And to be clear, there are still some litigations from 2019 that are happening in 2025. But the funding sources
that are kicking for sure. Right.
And so I just think it's enormously important to think about the long-term partnership, not just for the specific deal that you're negotiating, but again, once that first deal happens, who can you work with again? What is the likelihood that they will be around? What is the likelihood that they will be able to raise capital to satisfy the large capital needs of big corporations that are taking on more affirmative litigation? At the larger sizes of deals that occur in our industry, there really aren't that many capital providers that'll take on that risk, especially if it really is feeling like non-recourse risk and not credit risk.
Right.
The list is very small, and sometimes it's one. Right? Like when you're talking about high tens of millions, hundreds of millions of dollars to take on something that could potentially have a total loss. Yeah. There's probably only one portfolio in our marketplace that can absorb losses like that. To be clear, as management would require me to say, we're not looking to absorb those losses.
I was going to say, I have a couple $100 million of losses I could offload to you, probably by the weekend. So it's up to you if you want to shoot an NDA over after this call.
Sounds like an insurance product.
No, but here's the thing. But what I want to say, and then Dan will go to you, is especially if it's complex litigation where the legal issues are thorny. If you're not dealing with someone experienced, right? For example, you think about an antitrust case, right? And let's just say that the court looks at the relevant market in a Section 2 case in a way that nobody saw coming, right? You all internally can also independently make that assessment as opposed to the law firm trying to sell you. Whereas inexperienced capital might say, hey, these lawyers said it was going to go this way, it went that way, and it gets ugly. So I think that piece is vitally important of who the counterparty is after you close. And then David, go ahead.
Yeah, I think I want to highlight what Evan said about the capacity to do it, but it also gets at what are the funders telling you. I think we're in a better place today in 2025 than, let's say, 5 years ago, when one of the real dangers of what was happening when all this money flowed in, you had a lot of easy money flowing in, and then you had term sheets just flying. You remember these days, Ted. And we all sat around saying, it's going to take time for these to turn into losses, and then for those losses to wash through the system, and for the market to realize either those term sheets never should have been issued, or the pricing was off, or the risk allocation was off. Right. And that's exactly what happened in the market. but the legal departments and the law firms, it took actually, I don't know, Evan, a couple of years for that.
Yeah, because they can't tell. I mean, they can't tell what's sort of a fake term sheet, and if they see it and the website looks good, and they say we'll close in 30 days, believe me, that's a huge part. That's a huge part of when I get involved is when one of those has gone by the wayside.
Yeah, we've seen term sheets where we say like, boy, if they can close that deal, they should. They should. It's going to go. It's going to go badly for the funder, but if the firm can get that deal, they should. That's not good for the market. And I think we're in a period where we've recalibrated and people are much more realistic and much more sober about it. There are cases and there are portfolios that are not for us. Sometimes it's nothing but quantum. Sometimes it is straightforward, but there's a high degree of price sensitivity on behalf of the counterparty, and that's okay. So I do think there's room for lots of different types of funders, but I think Evan's right. When you get into the very, very complex, very long duration, high quantum, it's a very limited number of funders, and that's where we stand out, both because of the size of the balance sheet and the permanence of the capital and the team.
Right. Okay. Well, guys, look, I really appreciate you coming on today, and many thanks as always, and we'll talk soon.
Thank you for having us, Ted.
Thanks, Ted.
See you guys. Bye.
Thanks for having us.